it's possible that now that gold's above 2,000, it may never go below it again. We'll see. I mean, it probably will, but, you know, watch it over the weekend. Maybe gold's going to gap up on Monday. Maybe it's going to gap up to a record high. If it doesn't do it this Monday, it's going to do it at some point. And if it does, it may never look back. That's why, I've talked to the guys at Schiff Gold. They're going to be working all weekend. So just in case this is a big Monday, get your gold by Sunday night. You can still buy it. And remember, there's still 2 more days left of October. So don't think we're out of the woods yet for a stock market crash. We can crash on Monday, we can crash on Tuesday, and still make it in October. Now, of course, stock market can crash in November too.
Peter Schiff discusses the potential for gold to remain above $2,000 and highlights the anticipation surrounding its market performance, urging viewers to keep a close eye on it over the weekend. He warns of a looming stock market crash, emphasizing the historical declines in October and the possibility of further setbacks in November. Schiff analyzes the market fluctuations, noting the impact of companies like Amazon on the Nasdaq's performance and the significant drops in indices like the Russell and S&P. He observes the deflation of bubbles, especially in high-flying assets like Bitcoin, and questions the enthusiasm around Bitcoin-related ETFs, suggesting that the hype might not be justified. Schiff points out the rising bond yields and their correlation with gold prices, attributing both to inflation and a lack of confidence in the U.S. fiscal position. Let's dive into the rest of the video.
But, we've had some historical declines in October, and the market should be going down. In fact, it probably would have been down a lot more today if it wasn't for Amazon, which was up almost 7% on better earnings. So that kept the Nasdaq in positive territory. Although on the week, the Nasdaq was still down. I mean, it got beaten up prior to Friday on some, with some bad numbers. I think Google and some other companies, or Alphabet, whatever you call it these days, had bad numbers the day before and dragged the market lower. But the Nasdaq was down 2.6% on the week. That was the same decline as the Russell 2000. So the small caps got beaten up. The S&P was down 2.5% on the week, and the Dow was down 2.2%, down 360 or some odd points today, closing near the lows of the day. So setting us up for a potential big drop on Monday. Look at the ARK Innovation ETF, some of these real high flyers. That was down 10.5% on the week. So the air coming out of that bubble, a lot of money went into these AI type stocks. And I think now we're starting to see that deflate. Bitcoin too, I think the Grayscale Bitcoin Trust, which now everybody is convinced is going to become an open-ended spot Bitcoin ETF. And maybe they're right. Maybe the SEC is going to approve it. I mean, who cares? Because it's not bullish for Bitcoin. It's actually bearish. But that fund was up about 6% on the week. But I think what was significant is that it closed 9% below its high on the week. So it looks like the air is coming out of that bubble too. And again, shares of this trust were traded at a 50% discount, like not too long ago. People wouldn't even buy Bitcoin for 50 cents on the dollar. What makes anybody think they're going to rush and pay 100 cents on the dollar just because it's an ETF? They're not. Anybody who wants exposure to Bitcoin, there's so many ways to do it. There are already ETFs for Bitcoin futures. You could buy stuff like MicroStrategies, which is, for all intent and purpose, a Bitcoin play. And it's not like people have been stuck on the sidelines without a way to buy Bitcoin. Of course, they could buy it directly. This is all a bunch of hype. But all of this stuff is collapsing. The one thing that's rising right now is gold. But again, even the gold stock investors don't realize what's going on, because even they're not bearish enough. Even they don't understand. They're looking at the bond market. Yields on the 30-year Treasury were up again today. We closed the week north of 5%, 5.023% on the 30-year. And that's still scaring the gold stock investors. They don't understand that bond yields and the gold price are going to rise together, because it is inflation that is driving both higher, and a loss of confidence in the fiscal position of the United States.
In this next discussion, Peter Schiff discusses a looming crisis, America's mounting debt dilemma. He highlights an article about the nation heading for an interest payment crisis, shedding light on the severity of the situation. Schiff challenges the misconception that only interest, not the principal, needs to be repaid, emphasizing that debt must eventually be settled. He questions the sustainability of the current borrowing strategy, likening it to a Ponzi scheme where new creditors are needed to pay off existing ones. Schiff explains the escalating problem, rising bond yields leading to higher debt and increased inflation, making treasuries less attractive and worsening America's credit risk. He paints a stark picture of a self-perpetuating collapse, emphasizing the urgent need for a solution. Peter also reveals potential ways out during these uncertain times.
Now, I was reading an article in Newsweek. I got it on my phone here, and the title was America is headed for an interest payment crisis. And so at least they're writing about this. But they still don't get the severity of this. And it's not just the interest payments. It's the principal. It's not just that we can't pay the interest, but we have to pay the principal. You know, for years, people used to tell me, Peter, why are you worried about the debt? You know, we never have to pay that back. All that counts is the interest. We have to pay the interest, but we don't have to pay back the principal. In fact, if you ask most experts today, they'll say the same thing. We don't have to pay the principal. Well, my response to that was always, what do you mean we don't have to pay back the money? I mean, we borrowed it. It's a loan. I mean, that's the whole, nature of a loan, right? This isn't a gift that we got. The national debt wasn't a gift. It's debt. By its nature, debt has to be repaid. So when they would say we don't have to repay the debt, I would say, well, did you run that by the Chinese? Did you run it by the Japanese? Do they know that that's the deal? Do they know that they're loaning us money, but they're never going to get it back? Because, that's not a loan. That is a gift. They're not giving us this money. They are loaning it, and that means they expect to get it back. Now, of course, what people would tell me is, well, of course we will pay them back because we'll borrow it from somebody else. So in other words, it's a Ponzi scheme, right? So Bernie Madoff never had to worry about, paying back money because he would get it from the next sucker who didn't realize it was a Ponzi scheme. Well, what happens when people realize it's a Ponzi scheme? They don't want to participate. And that's what's going on. Our creditors don't want to loan us more money to pay back the other creditors. That is what is happening. That is why bond yields are going up, because the people who own the bonds want their money back as they mature, and we can't find new buyers. Now, prices are moving down and yields are going up, and so we're enticing some buyers into the market, but there's not enough. And here is the problem. Because normally you would think, okay, if there aren't people willing to buy treasuries, well, the yields will go up, and then the higher yields will be an inducement to buy. But it doesn't really work that way, because in this circumstance, as interest rates goes up, that impedes the solvency of the United States. Because as interest rates go up, we need to borrow more money to pay that interest, which means the debt goes up. As the debt goes up, America becomes a worse credit risk. And it becomes even more likely that we have to create even more inflation to service that debt, let alone repay the debt. So higher interest rates don't actually make treasuries more attractive. They make them less attractive. That is the problem. This is a bottomless pit. This is a self-perpetuating collapse that we are witnessing that is going to gather momentum. And so what's happening is we have to pay back the principal, the money that we've owed, because we can't find people. We have very short maturities on the national debt.
So let's recap. Peter Schiff dives deep into the world of finance, unraveling key trends and potential crises. He highlights the soaring value of gold and the precarious nature of the stock market, shedding light on the historical declines in October and the deflation of investment bubbles, including high-flying stocks and Bitcoin-related assets. Schiff also exposes the looming debt crisis in America, challenging the common misconception that only interest, not the principal, needs repayment. He elucidates the Ponzi scheme dynamics of excessive borrowing and the challenges in finding new creditors, leading to rising bond yields that paradoxically worsen the nation's financial predicament. As interest rates climb, the United States struggles to maintain its solvency, setting off a self-perpetuating collapse. Thank you for watching. Don't forget to like, share, and subscribe for future insights, and click the notification bell to stay updated on the latest financial news and expert analyses.